Hey, I hope you are doing well. Welcome to this video. This is going to be part 2 of the financial statement analysis series. And in this video, I'm going to talk about certain financial ratios. And I'll start with the company known as Avenue Supermarts Limited. So this company is a retailer based out of India, and it is also known by the name DMart. So for the analysis, I've taken the consolidated financials. So I'll start with the income statement first of all. So I have taken the financial data. So select financial data from the three financial statements: the income statement, the balance sheet, and the cash flow statement. And along with these financials, I've also given some notes for your reference. And below we have certain ratios that we'll calculate. I'll show you how these are calculated, what the formulae are, and on the basis of what values we will get, we'll analyze. And so I've added certain notes pertaining to the financial ratios as well. We'll discuss them along with once we are on the specific ratio. So without any further ado, let's jump into this video and start. So the select financial data for the income statement starts with the revenue. So this is the revenue from operations. It means whatever the company has generated from selling the products. Then we have the YOY growth, basically year-on-year growth. How have the revenues increased each year? So there has been a consistent trend of increase, but because of the pandemic, it decreased in FY20, and in FY21 there was a degrowth in the revenues. But again, in FY22 it has started picking up again. So this is indicative of the fact that because of the waning effect of COVID and increasing vaccinations, the company has started improving on the revenue front. So after this, we have the cost of goods sold. So cost of goods sold is nothing but the direct costs that can be attributable to per good that is produced and sold by the company. Then we have the EBITDA. EBITDA is basically the earnings before interest, tax, depreciation, and amortization. This is an important metric from the credit perspective. Then we have the depreciation and amortization expense. So D&A, as we usually call it, is nothing but the expense pertaining to a long-term asset for which the expected economic benefit is more than a year. So we do not attribute the total cost to the income statement in that period. So we spread the cost of that asset over the years or over the useful life of that asset. So there are different ways to calculate the D&A expense. We'll get into this in some other video. Let's move on and talk about the next metric, that is EBIT. So EBIT is called as the operating income. So whatever the company has generated from its operations. And this is before expensing the interest and tax. And this is the income that is available to all the investors, including the debt investors and the equity investors, or for that matter, the preference shareholders, so all the investors. After this, we expense the finance costs or the interest cost related to the debt. Then we reach the profit before taxes. So after this, we have some provision for taxes. In the final stage, we reach the profit after taxes or the net income to the common shareholders. And this is available to the common equity investors. So all the other investors have already been paid. So this is something that is available only to the common equity shareholders. Now on the balance sheet, we have the total debt. It will include the long term. So LT means long term, ST is short term debt. And then we have the current maturities of the long term debt. So current maturities is the debt repayment that the company is obliged to make in a certain period. Then we reduce the cash and cash equivalents to reach the net debt. So what we do is we just subtract the cash and we reach the net debt level. So this is negative. It means the company is cash positive or the cash is greater than what the company has borrowed. And then we also have the total equity. So I've also added current assets and liabilities. So whatever I have added here is going to be used in the ratios below. Hence I've added only the select financial data and not the whole financial statements. Then we have the working capital line items. Then I've calculated the net working capital. So payables are nothing but what the company owes to its creditors or suppliers. Then for receivables, it is the money that the company has to collect from the customers for the products that it has sold or the services that it has rendered to the customers. And inventories, basically what is the monetary value of whatever inventory the company has produced. So working capital formula is going to be the receivables plus inventories less payables. As you can see in the formula bar here. And after this, I have also computed the net working capital change, which is nothing but the current year net working capital subtracted from the previous year net working capital. So if there is a negative sign, it means that the cash is getting tied up in the working capital. And that is something that we would not want to happen, let's say, for a longer periods, or this amount is going to affect the cash at the bottom. But this is quite expected out of this company because the company has to spend money on the inventories. Only then it will be able to put them on shelf and then sell it to the customers. So I have also added certain line items for the cash flow statement. We have the capital expenditures. So capital expenditure is basically what the company spends for the expansion purposes. So we usually call capital expenditures as capex. So this is a jargon that is used in the financial domain. Then you have the cash flow from operations, from investing, and from financing. So I've taken all these here. Now I'll move on to the financial ratio analysis. Now, why are we doing the financial ratios? First of all, I mean, why are we analyzing these ratios? So if I want to, let's say, check the profitability of the company and I want to compare it head on with another peer or another player in the similar industry. So in that case, these metrics are going to be very useful, and it is about what you are trying to get out of all these ratios. So there are different types of ratios. You can check the company from the profitability perspective, or you can check it from the leverage perspective. Leverage is nothing but how much the company has exposed itself to the debt. So higher the leverage, higher is going to be the risk, right? So you can also analyze from the efficiency perspective. That is nothing but from the days perspective. Then we have certain cash flow metrics as well. So it is about how you're going to analyze the company. From what perspective are you trying to see, or what kind of bird's eye view are you trying to get out of the company? So let's start with the profitability ratios first of all. I'll start with the EBITDA margin. So start with an equal sign here, and I'll divide the EBITDA by the revenue from operations. So this is giving me 9.6%. So EBITDA margin basically tells me what is the EBITDA that is generated as a percentage of the revenue. So after generating that revenue, how much after expensing the expenses pertaining to the cost of goods sold and other indirect expenses, so how much have I generated in the earnings? Now I'll go with the operating income or EBIT. So for this, I will divide the EBIT by the revenue. Then PBT margin. PBT is nothing but the profit before taxes. So this is the profits that the company has generated before expensing the provisions for taxes, or before expensing the taxes, divided by the revenue. And operating income was whatever the company has generated before uh, the finance cost and the income tax. Then we reach the PAT finally, or the profit after taxes, or the net income as we call it, and we'll divide the PAT by revenue. So this is what I get. Now what I'll do is I'll just select all these cells and I'll press shift and the right arrow till FY22, and I'll press Ctrl R to replicate the formula in all the cells. So this is what I get. Now you might be seeing there are certain cells that have been colored. So this is nothing but the conditional formatting that I've applied here. So the green states the highest value and red is going to state the lowest value here. So we can see the margins have been on a slight decline here, but now have started increasing again post FY21. So this was mainly because of the COVID impact. So in FY21, all the values are low. And this conditional formatting is going to help you analyze even more efficiently, because you don't need to look at all the values. So just having a quick glance will give you a fair idea about how the company has been performing across all these fiscals. So return on equity means what the company has generated in terms of the net income, what is it as a percentage of the equity, or basically what the investors have poured. So what are they going to get out of it? Return on equity is going to be the PAT. So this is the PAT for FY18. So I will divide this by the average. I'll write average. Then I'll shift the tab. So I have the total equity here. So average of the current year and the last year equity. Whenever there is a balance sheet item and the other item is from the income statement or the cash flow statement, in that case we're going to use the averages for the balance sheet. Now this is because the balance sheet gives you a snapshot of what the company's assets or liabilities or equity is at a certain point in time. So if I'm saying it is FY18, so it means for the period ending FY18 or 31st March 2018, these were the values. So if I need to compute the value for FY18, it would be wrong to take just the value what just the value of the equity what it was at 31st March 2018, because there might have been certain issuances of shares or maybe repurchases. So because of this, there might have been some changes in the equity value, or it may have been or the changes might have been towards the end. So let's say throughout the year the equity value didn't change, but towards the end of the fiscal it changed because of certain actions of the company. So in that case, it won't be fair to take the value at the ending, but we should take the average so as to uh, narrow down this anomaly in case there is any. So I'll just press enter now. Return on equity is the profit after taxes divided by average of equity. So this is what I get. A return on equity we can define it as the long-term average return that the common equity investors can expect by investing in the company's stock or share. Now I'll compute the return on capital employed. So return on capital employed is going to be the return that all the investors of the company can expect if they are invested equally across all the instruments. So we are computing the return that is available to all the investors. So we need to take the EBIT here. That is operating income. So we'll divide EBIT by net debt plus equity for this period, then comma, the net debt plus equity, then I'll close the brackets. So this is what I get. The return on capital employed is 32.32% for this fiscal. Now again I'll select these cells and I will press shift right arrow key and I'll press Ctrl R to replicate the formula. Again you can see that the return on equity has been on a continuous decline till FY21. Now this has mainly been lowest in FY21 because of the COVID impact, but now it has started recovering again. Now if I want to look at what the reason exactly is for this decline, so I have to go back to the equity. So if you see, equity has been increasing year on year basis, right? So although the profit after taxes have also been increasing, but the rise in the equity has been more than what it has been on the profitability front. Because of this, hence the overall value has come down. But again in FY21, there has been an impact of the profitability as well. So this is how we analyze the return on equity. And for return on capital employed, you can see the similar trend as it was for the return on equity. And but here we can see the reason for this decrease in the first 4 years has been basically because of the decline in the debt balances. There has been the impact on the net debt. So if I say net debt plus equity, so this value has also been rising because of the declining debt balances, and hence the denominator value kept on increasing, which led to an overall decrease in the return on capital employed. So now return on capital employed is going to be the long-term average return that the investors across all the instruments of the company can expect by investing equally across all the instruments. Now we'll talk about the leverage or gearing ratios. So leverage is nothing but the debt. So how much the company has exposed itself to the external debt. First leverage ratio that we're going to compute here is the total debt to equity. So if I say equals, I have total debt here divided by equity. So you can also take total debt to equity from the perspective of the capital structure. So capital structure is nothing but a quick glance at the financing of the company. So how the company has financed its capital. So it can be either via equity or it can be via debt or it can be a mixture of both. So we can look at what percentage this is or debt to equity is. So on the basis of that, we can analyze and see how much leverage the company has taken. So if it is a higher ratio, that means the company is going for let's say risky proposition because it is exposing itself to a large amount of debt. So if the debt is increasing, it means that the obligations to repay in terms of the interest and the principal repayments is going to increase. So it is going to jeopardize its credit situation. The coverage ratio is nothing but how capable the company is to service its interest obligations. So for this purpose, I'm going to take the EBIT or the operating income, that is this, divided by the interest cost, this. Now I'll put a negative sign here because interest cost was an expense. So this is going to be 21.5 times. So this means the EBIT or the operating income is 21.5 times the interest cost. This means that the company is in a very comfortable position to service any of its interest obligations. Then I have the total debt to EBITDA. This is also one of the leverage ratios that we usually compute. So for total debt, I'll take this value and I'll divide this by EBITDA. So this means what percentage the debt is as compared to the EBITDA. So lower the number, it means the debt as compared to the EBITDA is low, and it means that the company is in quite a comfortable position. Again, I will press Ctrl R and I will get all the values across these fiscals. So as you can see, the total debt to equity has been on a continuous decline. It has reached zero values because here debt has reached zero in FY21 and 22. And for the coverage ratios is on a continuous rise. It means the operating income as a percentage of the interest obligations has been increasing here. So similar trend can be seen on the total debt to EBITDA front, as we saw on the total debt to equity. It is sort of decreasing each year. Now we'll do the days analysis. This is also related to the efficiency of the company or how efficiently the company is managing its operations from the cash perspective in terms of collecting them or paying them or basically selling the inventories. Days sales outstanding. So this is nothing but on average how many days a company takes to collect the cash from the customers for the products that it has sold. So it is going to be average of the receivables. So these are the receivables. So I'm going to select these 2 years average and then I will divide by the revenues for the current period and then I'll multiply by 360. So you can take it as 365 or 360. So I'm taking here 360. So this is going to give me on an average how many days does the company take to collect the cash from the customers. So it is showing me as 1. Now for inventories, I'll put a negative sign first of all because I'll have to relate it to the cost of the goods sold. Now for days of say days inventory outstanding, I'll put average. Sorry, this is average, and then I'll go to the inventories. I'll take the average. Then I'll divide it by the cost of goods sold. That is nothing but the sell, and then I'll again multiply it by 360. So this is giving me 30 days. Then for the payables, again I'm going to link it to the cost of goods sold. So I'm putting a negative sign here. So this is average of the payables divided by the cost of goods sold multiplied by 360. So this is 8 days. Now I will calculate the net working capital days. That is nothing but the days sales outstanding plus the days inventory outstanding minus the days payable outstanding. I'll select all the cells and press Ctrl R. So if you see, the days inventory outstanding are going to be the average number of days the company takes to sell the inventory or the existing inventory, and days payable outstanding are the number of days on average that the company takes to pay to its creditors or the suppliers. So here you can see the net working capital days are nothing but how many days on an average does the company take to convert the inputs back into cash. So inputs are going to be in the form of procuring the raw material, then adding some value in terms of, let's say, labor or equipment, then some value addition in terms of the skills, and after that, let's say there's a work in progress inventory, then final goods are produced, then those are sold, and the cash is collected. This is called as the net working capital days or the cash conversion cycle. Now we'll go and calculate some cash flow metrics. So first of all, we'll have a look at the capital expenditure percentage revenue. So how much the company is spending on the expansions if I compare it to the revenue. So what it has generated and then what it is going to spend for the expansion. So for this, I'll put a negative sign because capex or the capital expenditure is an expense and it has been shown in the negative. So then I'll divide it by the revenue. Then I'll press Ctrl R. So as you can see, the average comes out to be around 7.2%, and it is kind of steady across all the fiscals. So this has to be a sort of steady number with an increasing trend. So if the company has such a, let's say, such a trend of increasing capex percentage revenue, so it means that the company is trying to expand and generate more revenues out of the increased expansion. But if we see there has been a continuous trend of or continuous declining trend of the capex percentage revenue, so that might be a little problematic area, and the person must explore or see or delve a little deep to understand why the company is not spending on the expansion. Now we'll calculate the delta NWC, or basically the change in net working capital as a percentage of revenue. So if I say equals, so the change in net working capital is this, I'll divide it by the revenues. Okay, so this is a negative percentage. Again, you can see for these 5 years, the average comes out to be around 1.3% of negative. And as I talked about earlier as well, this is a company that is operating in the retail sector. So a negative change in working capital is kind of expected because of the increased expenditures on the inventory each year. And you can see that the inventory expense has been increasing again and again each year. So basically what the value of inventory is, it has been increasing. So in order to do that, you'll have to spend cash. Hence the net working capital change is predominantly going to be negative here. Although I would not want this to happen, but I think this is something related to the sector or the industry the company is operating in. And finally, we'll calculate some liquidity ratios here. So this is about how much cash or the current assets the company has as compared to the current liabilities. So higher these ratios, better is it is for the company. So for the cash ratio, I'll put a negative sign because I've already added a negative sign because of the computation of net debt. So cash and cash equivalents divided by the current liabilities. All right. Then for current ratio, I'm going to put the current assets divided by current liabilities. So what percentage the current assets, or how many times the current assets are as compared to the current liabilities. So if I see the results across all these years, so what I can see is on the current ratio side, we can see that the number is quite high. So the current assets are approximately at least 1.6 times the current liabilities. So if higher the value, that means it is better for the company because it has more cash at hand as compared to the current liabilities. So this is about the financial ratio analysis. Here on the return on capital employed, I also wanted to talk about one more thing. Since I have computed return on capital employed on the basis of EBIT or the operating income, so I'll also take into consideration the tax rate here. So if I want to see how much post-tax I am going to generate, or the return on capital employed, for that what I'll do is I'll say EBIT into bracket 1 minus the effective tax rate. So effective tax rate is nothing but what tax rate the company paid. So this is going to be on the basis of what the provision for taxes were as compared to the profit before taxes. So I'll say this and I'll close the bracket. So this is going to be my formula. So as you can see earlier the value was 32%, but because of the tax it has come down to 21.1%. Now I will copy it and I'll select all these cells and I'll press Alt ES and F formula. So as you can see the values have come down. The return on equity was already post-tax because this is in this we are taking the numerator as the net income, and net income is after the taxes. So this is all the investors can expect in the long term, the return from this company. This is about the analysis of Avenue Supermarts or T-Mart. So do let me know if you have any comments or have any doubts pertaining to this video. And again, I would recommend you to see my last videos if you want to gain better clarity about certain concepts, because this was mainly related to the ratios, hence I did not delve into all the concepts again. So I'll add the links in the description so you may check those out. See you the next time. Thank you.